Usually, those familiar Fibonacci numbers from 0 to 1 form curved levels within the wedge. Extension levels are optional and usually won't be used. In fact, we won't really focus on the levels, even the ones from 0 to 1, because almost everything that can be done with the levels within a Fibonacci wedge can also be done with Fibonacci circles, arcs, and even spirals in some cases. What we'll mainly be focusing on is the structure of the wedge with its two trend lines. And since the Fibonacci wedge has a curvature, it is important to lock scales to avoid distortions when moving the chart and zooming in and out. This was already covered in the series on Fibonacci spirals and applies to Fibonacci wedges just like it does to Fibonacci circles and arcs. If you're interested, these have already been covered along with many other Fibonacci tools. You can find this material on the channel or website. Technically, the Fib wedge has a range of movement from 0 to 180 degrees and can face up or down. Normally, it will be positioned at an angle from 30 to 90 degrees. The way the Fibonacci wedges first set on the chart is heavily dependent on how the first trend line is drawn from the first to second point. It's also important to make little to no adjustments after the wedge has been set on the chart. See, first we draw a trend line like normal with 2 points, and there's freedom of movement to move it anywhere, while still being able to change the position, length, and angle of this trend line. The third point, which will connect to the first point, forms the second trend line. And before we even set down this third point, the length of this second trend line is already determined by the length of the first trend line. Of course, we could adjust the length after the wedge has been set down, but as you'll notice, moving the points after the wedge has been set down can drastically alter the entire wedge. Similar to the Fib circle, the Fib wedge is more particular with the specific conditions and points where it can be applied on a chart. This is because, like those other Fibonacci tools with a curvature, the Fibonacci wedge incorporates the aspects of price and time. So follow along this quick yet detailed tutorial that uses a series of real chart examples to explore the various uses of the Fibonacci wedge, with a variety of charts from various time ranges, in order to understand the general advantages and disadvantages of this Fibonacci tool to find conditions where its application is more suitable. So regardless of when you watch this, or which charts you choose to apply the Fibonacci wedge on, information presented here can be of use to you. During a downtrend, a Fib wedge can be placed with the first trend line running up the length of an upward retracement. Then we rotate the third point down to be horizontally in line with the first point. This forms the second trend line, which will be horizontally flat. This horizontal interval of time is determined by how long the first trend line is from the first to second point that spans from the low to the high of the upward retracement. Naturally, this structure from the beginning of the upward retracement provides potential support for a falling price. And of course, that support isn't guaranteed, especially with an ideal bearish situation like this, where sustained selling keeps pushing down price after a gap down initially breaches this area. In theory, that horizontal length of the Fib wedge marks an approximate duration, where support from the beginning of an upward retracement provides stronger potential to oppose falling price. After this time duration has passed, supports around this area will still exist, but it will often be potentially weaker, and can more easily be broken through with lower amounts of sustained selling. That being said, it's still possible to have price not contact the support area from the upward retracement during the time when it is potentially stronger, and if price does later return back down to this area, falling price can still be opposed. Ideally, when price does come back down to contact this area, it will be in a situation like this with much less bearish activity, such as low red volume and a much shallower decline of price. While it would be highly advantageous for a gradual acceleration of buyers to decisively drive price up immediately, or shortly after contact with this area, the idea is that after price begins to fall, following a bullish movement, there's a proportional amount of time when selling has to increase and be sustained to decisively reverse the gains of that bullish movement. Often a shift back to a seller's advantage within this duration is difficult, especially if the bullish move was a steep one like this, because in order to drive price back down to that bullish reversal point within a proportionally shorter time duration in most cases, selling pressure normally gets exhausted easily by the time it nears that support area. And even if selling is initially strong, such as in this case, price can still flatten as a bullish advantage will remain at this area to some degree. Often when contact is made with the support area during this duration, it's possible but less likely for an injection of increased and sustained selling volume to rapidly continue the initial drop. If there's a delay to continue the drop below this area, the market will naturally flatten and even begin to incline, because during that bearish pause, there is an opportunity for buyers to more easily drive price back up for at least a short-term bullish advantage. In this case, however, previous highs are not surpassed, And in the broader context, the time advantage for the support area has passed. So it's not a surprise to see a break lower, especially with those ideal various conditions we've seen before, with a gap down followed by sufficient and sustained selling. Now let's apply the fib wedge during a gap up situation. You'll notice with the additional bullish context of a gap fill, the potential for an upward reversal is naturally increased, and it's possible for this to take place with less of a drastic increase in buyers. Then, as you may have noticed by now, the curved levels of the fib wedge do interact with price movement to some extent, but this is often a minor characteristic to pay attention to, in comparison to the main focus of the trend lines. Now, with a return back to falling price, we can observe a scenario where a gap down does take place, but doesn't directly reach our support area of interest right away. And although price does resume the fall relatively quickly following the gap down, selling pressure quickly subsides and isn't at exceedingly high levels. So that's why, even though it's been quite some time since the theoretically stronger duration of support has passed for this area, it's still important to pay attention to more recent developments to better understand why a bullish to neutral phase has emerged, rather than the rapid continuation of a downtrend. When using the fib wedge to find potentially stronger resistance, we follow the same method we used for support, except we place the first trend line from the high to the low of a bearish movement. This will then determine the length of the second trend line, which runs from the first to third point. We then position this horizontally to give us the approximate time range of when resistance could be stronger. In this case, since it's an established downtrend, our potentially stronger resistance area isn't even directly contacted. Now we'll apply the method in a situation where price begins to reverse back up as a downward retracement within an established uptrend has potentially halted. Place the first point at the high of that sharp peak. Then take the second point down to the most recent upswing and then rotate the third point back up, so it's horizontally in line with the first point. And there is indeed stronger resistance during this time range. Extending down to the more recent lower upswing point produces similar results, and of course will be slightly longer. Now, with the return back to a clear downtrend, we can repeat the same process at these new highs and new upswings. It won't be uncommon to have results like this, where this horizontal portion of the wedge does not get put into use, since price doesn't return back anywhere near it and instead keeps dropping to progress the downtrend. With such development, we can then again adjust by extending down to the more recent upswing point. But this isn't very useful since price isn't even anywhere near our resistance range of interest, and more importantly, that time range has already been passed. And it's a similar outcome when we reference a more recent downswing point to place the first point of the fib wedge, because naturally everything becomes proportionally shorter. But with this recent gap down and rebound, we end up with a wedge that gets good coverage in terms of price and time. Realistically, several wedges could be applied before one is even put to use with price nearing its horizontal resistance range. This resistance range is indeed potentially stronger during the specified time range, but there's a sufficient increase of buyers entering the market to drive over this barrier. During the run-up to this breakout, price closely approximates the curvature of some of these levels. This kind of movement could also better be observed with fib arcs and circles. It's not our main focus with the wedge, and such movement doesn't guarantee a successful breakout. To assess that, we simply focus on how price and volume develop upon contacting the horizontal portion of the fib wedge. First, find a position for a regular uptrend line, and then reference an area of major resistance potential, such as the bottom portion of this bearish continuation that also lines up with downswing points. After that, go from the lowest portion of the uptrend line to form a vertical line that will end horizontally in line with the highs of that bearish area we referenced. Then rotate the third point down to form the regular trend line, which means aligning this trend line with the second upswing point we referenced. Any portion of the uptrend line after the boundary of the wedge is theoretically weaker, but can still oppose falling price to some degree as it's being broken through. As the downtrend continues, we eventually get conditions suitable enough to apply this method. Again, we have those swing points for the basis of an uptrend line, and we can reference these areas overlapping with the area of our recent downswing point to reference highs for the top of the fib wedge. Just like before, we go from the lowest point of the lowest upswing point straight up to the highs of the recent downswing point and most immediate area of resistance. Then we rotate the third point down to form a trend line that is aligned from the first to second upswing point. Except in this case, the second upswing point can't be reached because it's too short of a length, which was determined by the vertical portion of the wedge. We could move up to this area from the middle of a past bearish continuation, but it doesn't contain any major or clear downswing points. Nor does this area overlap or line up with any downswing points that take place after it, However, this area above it does. So we start from those same lows. Next, we extend up to be horizontally in line with the highs of this new area. Naturally, this will result in a much longer trend line when we rotate the third point down to encompass the same second upswing point we referenced before. Again, we might get some interaction when price is in contact with the curved levels of the wedge, but this is a secondary characteristic of lesser importance. We focus on the trend line extending past the boundaries of the wedge, which is now potentially weaker at opposing falling price, even if selling volume isn't particularly high. Now, you might be wondering why we chose this upswing point instead of this one, which appeared closer in time to the first one. That's because the resulting upswing didn't send price over the highs of this first downswing point of our potentially developing uptrend, whereas the next upswing we referenced resulted in price surpassing that high. In this next situation, those conditions are present as rising price from the second upswing point surpasses the highs of the first downswing point, which formed following the initial first upswing point. In terms of the highest point to reference, it's a clear decision here with the sharp peak, where it's nice to see some overlap with the same range where a bearish continuation took place. As usual, we form a vertical line from the level of the lowest point to the level of the highest point. Then we rotate the third point down to form a trend line that runs through the first and second upswing point. When price drops back down, we've already passed the boundary of the wedge. The trend line can still be a barrier to reaching lower prices, but these conditions are preferable from a bearish perspective to more easily break lower without an exceedingly large increase in selling volume, because by this time selling pressure isn't as exhausted in proportion to when it was during the boundary of the wedge. During that time, relatively weak bullish volume and price movement was able to sustain a decent uptrend within the boundaries of the wedge in terms of price and time ranges, due to that section being a price and time range on the chart that had sold off proportionally too much to sustain a further drop. When applying the fib wedge, it's generally best to avoid situations like this, where initially there's a steep drop quickly followed by price stabilizing to a shallower angle. And in this case, since a large downtrend is developing further, we'll have to reference a major area of support potential, and the site of a clear major upswing that is below where price is currently at. Then we have the two clear downswing points go to the highest point where the downtrend initially began. Then take the second point straight down to be horizontally in line with the lowest price level that was referenced. Finally, rotate the third point up to place a downtrend line that runs through the downswing points. The portion of the downtrend line that extends past the boundary of the wedge has potential, albeit theoretically weaker potential to resist rising price. Even when there's just a moderate increase of green volume upon contact with this trend line, it's possible to extend the vertical line lower to expand the wedge by placing the second point of the wedge horizontally in line with the lowest price level of a significant bullish reversal area. In a scenario with a large trend like this, conditions are less suitable compared to a situation where a wedge can be applied over a shorter time span and price range. It's even better if within a defined horizontal range, we can reference a series of sharp and clear swing points that have recently formed. Although the most recent upswing point around this area does go lower than the previous upswing points, it's not significantly lower to make a huge difference in this case. Our lowest point to apply the fib wedge with this method needs to be referenced from an upswing point that took place before the formation of the two downswing points we'll be using for the trend line, rather than an upswing point that took place between or after the formation of these two downswing points. Like normal, we start from the highest point of the first downswing and go straight down to be horizontally in line with the lowest level of the upswing point that took place before the two downswings. Then we formed a trend line running through the two downswing points by rotating the third point up. Since price keeps making newer lows at this lower boundary, the coverage we get from this wedge isn't as useful for determining the potentially stronger and weaker portions of a downtrend line. That's why, as the chart progresses to reach lower, we need to adjust and plot a new fib wedge with more recent swing points. And it's possible this process will have to be repeated several times, due to the maintenance of this neutral to bearish posture that does see the breakthrough above shorter-term trend lines, after the boundary of a fib wedge. However, after briefly closing over these downtrend lines, no significant uptrend develops to move the chart out of this neutral to bearish context. Now this time, when we apply the wedge in the same way, there the usual break of the trend line after its strongest resistance potential within the boundaries of the wedge is passed. This also helps identify the weaker intersection of the trend line by the time there's contact with the upper portion of a potential double bottom range. With persisting resistance at previous highs, we could be repeating the same process of applying a fib wedge in the same approximate price range if we soon get a lower downswing point to maintain the bearish to neutral posture on the chart. Since this doesn't occur, and price finally breaks higher, we wait until this new, larger uptrend begins to end, and form those familiar characteristics for the application of a fib wedge in a bearish context. Then when price eventually does return back up to contact this trend line, we need to pay attention to that short-term bullish context because that recent influx of buyers entering the market is more than sufficient to break over the downtrend line, especially now that it's contact with the downtrend line after the boundary of the fib wedge. We chose this more recent upward reversal area even though it was less significant compared to the double bottom reversal because this was closer to where price was trading at, and the chart did not end up closing below this area. So it was better to keep things in this shorter and more relevant context. Though if we did extend down to the lows of that upward reversal from the double bottom, we could see the discrepancies where price is able to cross over this stronger portion of the downtrend line within the boundary of the wedge, rather than the theoretically weaker portion after the wedge, without a major spike in green volume being maintained during contact with the trend line, which is possible but generally less common. It's more common for this stronger portion of a trend line within the boundary of a wedge to be broken through with higher sustained levels of volume. However, as we've seen in previous examples, it's quite possible to break over a trend line during the weaker portion after the boundary of a wedge with lower levels of volume. With recent developments, entry into the 65 to 75 range becomes more plausible. Specifically, what's been happening in the well-defined 49 to 63.50 range, where there's been a definite shift from a neutral to bullish slope. In fact, there's even a more well-defined short-term slope up against 63.50, which becomes part of an ascending triangle formation. A fib wedge could be applied right at the beginning of the ascending triangles formation to define the initially stronger duration of resistance around 63.50, which of course began to diminish nearing the end of the triangle. Then we can apply that similar concept we learned in earlier sections for the trend line in order to better identify approximately when the conclusion to the ascending triangle is close. This first portion is when containment of price within the triangle structure is the greatest. In fact, it's actually quite close to perfect textbook example proportions, in that the triangle can be divided into thirds, as demonstrated by this repeating interval of time that shows the boundaries of the triangle becoming weaker in terms of containing price as the chart heads into the second and third portions of the triangle. In this case, since price managed to stay up in the triangle after the second third, a successful breakout was much more likely over weakening resistance around 63.50, heading into the final third of the triangle. Initial observations on this chart, a steep downtrend has been reversed. Though recently there's been a moderate retracement, which provides clear ranges to reference, as another bullish acceleration is currently underway. A fib wedge based on the range of the bearish retracement provides further detail on this most recent uptrend line. The strongest bullish sentiment for this incline has passed, so any drop onto it in the future can provide weaker support, and actually does result in the chart breaking below it. When the fib wedge is used in a trendline context, some of its levels here can identify areas of resistance to the uptrend. Similar to a fib arc or circle after there's a break below our main trend line, a fib fan can help identify possible trajectories the chart can fall onto, especially at areas where there's contact with intersections between fan lines, and this range now reversing roles to offer firm support. And even when the fib range is dragged higher to the most recent peak, it's still possible to get a retracement level intersecting with the fan lines at the same approximate areas. Like a typical longer-term downtrend, brief pauses and bullish retracements can still be found in the short term. Given the broader bearish context, it's unsurprising this short-term bullish movement doesn't amount to much. A fib wedge based on this bullish retracement helps confirm there's weaker support at this clear level during the time of contact, when that bull hammer candle formed. And now, with a rebound back to the same level, it's reversing roles to offer resistance. So it's a good opportunity to elaborate on this uptrend line further with the application of a fib wedge based on the final leg of the previous downtrend. And since overlap with the trend line and the fib wedge has long passed, there's limited support potential as the drop progresses lower to contact the trend line. As a small to moderately sized uptrend emerges, a simple first step can be to apply a fib retracement. Then we can drag it higher as downswing points form at these higher ranges. Then get a better idea of resistance strength by placing a fib wedge on this recent bearish retracement to reveal that resistance is currently past its theoretically strongest duration. This becomes even more important now, since in the short term the chart is not retracing very low, and instead maintains consistent contact with this resistance area, which contributed to the acceleration over the now theoretically weaker resistance area. which naturally reverses roles to become a key support range as the bullish acceleration slows down and transitions to a normal bearish retracement, leading to another reminder to expand the fib retracement up to the most recent peak. Then, as there's expected support falling down onto this range, face a fib wedge on the upswing point. After passing the horizontal duration of the wedge, it's quite normal to see contact below the support range. However, this example demonstrates quite well how a decisive break lower isn't guaranteed, even though support is now theoretically weaker. Since there's a clear rebound and a drop, we can repeat the same process again. Support is again theoretically stronger during the duration marked by the horizontal portion of the wedge. In this case, there's barely contact with the upper portion of the range when there is relatively flat to eventually bullish movement. Fib arcs based on the same upswing point demonstrate why we usually don't use those curved levels within the wedge and the extension ones, because fib arcs will usually do the same thing, but more comprehensively. In this case, the chart closely approximates the curvature down, and the intersection with the fib retracement level almost exactly marks the area where the drop halts. But of course, that doesn't mean it's a guaranteed reversal, only that there could be greater opposition to the downtrend around the time of that intersection. And it's a similar situation in terms of slightly greater resistance potential when rebounding and contacting this range that now offers resistance. For more Fibonacci methods, as well as indicators, follow Ascencore. Thanks for watching and have a nice day.